Welcome back to another episode of Investing Explained. Here's today's question.
I'm hesitant to respond with just a cookie cutter response, though, because a lot of it has to do with you personally. And so let me expound on that. How old are you? What do you plan on doing as far as more work? All those kind of things come into play. Do you have children? Do you have other interests? There's so many different things that come into play as to how you would respond to that. But let me give you an example. Recently, I had a friend who contacted me and he said, Preston, I need some help. I just retired out of the military. He was a pilot that I knew. And his income was basically going to start doubling, if not tripling, from where it was whenever he was in the military. And he says, I'm going to have a lot of extra money to invest. What should I do? What should I do with the money? And I started asking him a few questions. So one of the questions I said, do you own a house? Did you just buy a house? He said, yeah, I just bought a house. And he still had a lot of money to pay down on the house. And I said, well, what's the interest rate on the house? And he says, well, it's a fixed loan, 30-year loan at 3.75%. And I said, okay. And so for me, whenever I was trying to help him through this, now he has children, and so then you had to come in and you had to think about the college expenses. But basically my advice to him after laying some of this stuff out, and it's important to note that this conversation recently took place in March of 2016. And the reason I say that that's important is because in 2016 in March, the stock market right now in the U.S., if you're going to invest in the U.S. stock market, it's priced around a 3% return. So if he takes his money, that's all this extra money that he's making, and he puts it straight into the stock market, 3% return is what he could expect by putting it into an S&P 500 index. Now, when you look at the 10-year treasury, if you were going to do a bond, that's at around 2.6%. So not much of a difference there, 2.6 to 3%. That's almost the exact same return. But he also has this house loan that's at 3.75%. So for me, whenever I'm thinking through where's he going to get the highest return on his money, that's for the house, it's like very low risk. I mean, the only risk that he's going to have is if the house starts losing value and he needs to turn around and sell it, which in my opinion probably wasn't the case for him because I think he'd be in that area for a long period of time. For me, the best advice for him was start paying down the house loan as much as you can because you're actually probably getting the best return that you could based on the current market conditions. As those market conditions change, let's say in 2 years from now, the stock market has a big correction and prices are a lot better, and now you can go get 6% in the stock market. Now he needs to be taking his cash flow and putting it into the stock market. So that's why answering that question is extremely hard because a lot of our listeners are from the future. They're listening to us 4 years from now. They're listening to this episode. And so if I'm giving you advice to buy the stock market today, that's really bad advice for that person who's listening to this 4 years from now because it might be completely different. I would guess it'd actually be better, but it's different advice based on where you're at a certain point in time and all the other conditions that are happening. So with all of that said, because this is a really long response, but I think it's important for you to hear my thought process. That's what I really want to convey to you. This is how I would go about this. Lay out different asset classes and understand where they're priced. Know where the stock market is. And all you got to do is take the inverse of the Shiller PE ratio for the US. Figure out what that ratio is and what percent that's giving you in the stock market. Figure out what you can get in a government bond. Figure out what you can get in a corporate bond. Do you have a house loan? What's the percent on that? Those kind of things are the questions that you guys have to ask. And then you have to make that assessment. What's going to give me the highest return for the lowest amount of risk that I'm comfortable with? I know that was long, but I'm curious to hear your thoughts.
I have a very lengthy response too, Preston. So I definitely won't blame you here. The one thing I really wanted to talk about in your question was basically a two-part question, was also the thing about a high percent of net worth, because that's something that we really haven't been talking too much about before. When you say that these call it $500,000, that's a huge part of your net worth, I would assume that you have savings to live by and you also have an emergency fund, and there at least quite some time until you plan to retire. Again, like Preston said, there's so much information we need to know, like age and children and which kind of different scenarios are you considering going to happen with your life. But the thing I really want to talk about more from a general perspective, that is 100% stock exposure a good investment? Is it risky? Do you need to diversify more into different asset classes? Because I think that's something that a lot of people have thought about, and at least I know I've thought a lot about it. Am I really diversified if I have 100% in stocks? Now, it's not a simple yes or no question, but I would definitely like to give it a go. If we look away from the current market conditions, again, a lot of the listeners, whenever you listen to this, you might be in the future and the stock market might look very, very different. So just from a general perspective, are you diversified if you have 100% stocks, given that it's only one asset class? And you might have seen a chart saying, if you have stocks, you will on average be making 8%. Or if you're investing in bonds, on average it would be 4%. Commodities, perhaps 3%. Then you're also showing charts about how those asset classes correlates and how you will have less risk if one asset class goes up when the other asset class goes down. And we've talked about risk quite a few times here in the podcast, and we usually don't consider volatility to be a good measure of risk. And for me, I don't think that having many asset classes, for the sake of having many asset classes, is a good investment. I don't necessarily think that you are more diversified. And I don't think as an investor that you have respect for the underlying drivers in terms of what drives returns. So please allow me to elaborate. I don't look at stocks as one asset class. Rather, I look at it as, can I imagine a scenario where companies in aggregate are not making a profit anymore? And the answer to that is pretty simple. No, I can't. So basically, the underlying premise is that if a company makes money, it will be returned to the shareholder in dividend, share buyback, or capital gains. So I would say that I can't imagine a scenario where companies won't be making any money. So basically what you're saying in terms of the low-cost ETF, as you're talking about, over the long term, yes, there will be a good investment. If I need to build up on that thesis, I can't think about any point in time since we have human beings on this planet where we didn't have a corporation making an output. Now, it might not have been called the SEC, or they might not have antitrust laws, and they might not be filing in 10K, but we always have a corporation structure one way or the other. I mean, even back when we were living in tribes, we had the owner, management, worker structure. And in aggregate, those societies got wealthier. So you might also be thinking, okay, Stig, so that's a good point. Okay, so up until this story, we can see that companies are making profit. Can we expect that to happen in the future? If you investigate how a company makes profit and how societies prosper, it basically comes down to innovation. The more productive we become, the richer we get, and that generates profit. You can think of it in terms of inventions. We become more productive after electricity was invented, the assembly line, computers for that matter. And it's basically a rule of nature. You'll always find a corporate structure. Unless we completely dissolve the structure of a corporation by telling people that they can't be working together, we can always create more output by working together in a structure one way or the other. I know that this was a very philosophical and very lengthy approach to understanding stocks, but I think it's important to understand the underlying factors of what drives the stock market, again, over the long run. So just to sum up, if you're not thinking about retiring anytime soon and you're thinking about, should I be 100% exposed to stocks if we disregard the current price level, I don't think that you need diversification into other asset classes.
That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.